Okay, everybody, thank you for coming to my session. This is a paper on systemic fragility in decentralized markets, and this is joint work with Christine Palour from UC Berkeley. So what are we looking at in this paper? We want to look at contagion and systemic risk that is emanating from DeFi. There's been a lot of work on this topic in mainstream financial markets. We looked at systemic risk in banking systems, and between stock markets, but there's almost no work on DeFi. And why is that interesting? Because it's kind of unique. Their capital can move freely in DeFi markets. There is innovations like flash loans that overcome capital constraints, so everybody has arbitrary large amounts of capital for a short period of time. These are also closed information systems, so everything is on chain. That allows us to explore in greater detail what is going on. We cannot see exactly in traditional financial markets when somebody puts an order in for a sale and what price to sell at and who sells. We can all observe that on the blockchain. Also interesting, there's no regulators, there's no circuit breakers, which means that there's a stop to trading when the price moves a lot. There's no lender of last resort like the central bank that we can rely upon that will bail everybody out if things go really bad. So we don't really have anything like that in DeFi markets. So we look at collateralized lending. That's the largest DeFi application. This is about $53 billion in total. We look at the two largest protocols, Aave and Compound, in this paper. So we document systemic fragility in these lending platforms. We document spillover effects, and we also document negative feedback loops. So the idea is typically how this works is that when an under-collateralized loan gets liquidated, the collateral gets often immediately sold on a decentralized exchange. This creates downward pressure on the collateral, price of the collateral, which means more loans are under-collateralized, and so more loans get liquidated. Again, then you start from the beginning where this creates a negative price pressure and more loans are under collateralized. And so we can see these large liquidation waves that happen. So just to give a basic idea, how does DeFi lending work? So we have the borrower who deposits some collateral with the lending platform, say Aave, and then borrows something against that. For example, here 1 Bitcoin is what we borrow against that collateral that we deposit. So in these DeFi platforms, the value of the collateral always have to be greater than the value of the outstanding debt. So here we have often a factor of 1.2, and this is similar to the traditional financial markets where we have the repo market or margin accounts. If you're a broker, you have a pretty much a similar system where the value of the collateral always has to exceed the value that you borrow. How do liquidations work in these markets? So what happens if the loan is not properly collateralized anymore? So if the value of the collateral decreases, then this loan is up for liquidation. So anybody out there can go in, become a liquidator. They can liquidate the loan. So they repay the loan with 1 Bitcoin, for example, here, and they obtain the collateral in return. What does the liquidator do if she doesn't have enough money? If there is no Bitcoin that the liquidator has, she can always go and borrow the funds in a flash loan. So flash loans are transactions where you borrow the funds and repay them in the same Ethereum transaction. And since transactions are atomic, there's no credit risk in this transaction for the lender. So you borrow a Bitcoin on a flash loan, use that to repay the collateral, obtain the collateral, and then if you need to repay the flash loan, then you immediately swap the collateral on a decentralized exchange and swap it here for, in our example, for 1 Bitcoin that you can use to repay the flash lender. And there's a profit for the liquidator that is left over because the amount of collateral exceeds the money that has to be repaid for the loan. So this can cause these negative feedback effects where there's a price effect, the oracles update, the loan's up for liquidation, the collateral value goes down, and so then we see that more loans are under collateralized. That pushes the oracles to update. Prices are lower, more loans are up for liquidation, and we can see a large liquidation wave unfolding. So we look at all liquidations from AVE and Compound from 2018 to 21. In the paper, we have about 24,000 liquidations and a bunch of different collateral and debt tokens. This is a huge market. The total value of the liquidations is about $1.4 billion in our sample. So here is one such liquidation wave as an example. So what we see here in the gray area behind, we see the amounts of collateral tokens liquidated. So these were link token in this example, which happened on May 1921. And what you see here is that the price of the token falls as this liquidation wave starts to unfold. So we have the prices up here from various exchanges, these colorful graphs, and you see that they pretty much all go down. Now, most of these loans were actually, the collateral was sold immediately on a DEX, which was mostly sushi swap, so that's the blue line. But we see that there is also what we call in finance a contagion effect to other exchanges. So we see that Uniswap, for example, prices also fell immediately. And there was even a contagion to other exchanges that are outside of the blockchain system. For example, Binance, which is not an on-chain, it is not really affected by all of this. There was no collateral sold on Binance, but we still see that the prices on Binance, the green line, also drops. We can also tease out how much of that price impact is due to these liquidators that immediately turn around and sell the collateral, and that's the red line. So we see that these liquidators cause quite a big drop in the token price, and a lot of that initial drop is due to these liquidators who are selling the tokens immediately. Afterwards, we can see that if it was just up for the liquidators, the prices would have fallen more, but there was obviously somebody else who was buying on the other side. But we still see that there was some permanent price impact from this liquidation wave, and prices stabilized at a much lower level than before. So these loan liquidations do have some serious impact on the return distribution. So here we look at 5-minute returns of collateral tokens, and the distribution in blue shows you the return distribution when there was no liquidation, and the orange graph shows you the return distribution when there was a liquidation. And what we see is what we call in finance very often fat tails, which means that the extreme returns are much more likely than one would think if we believe, for example, in a normal distribution. So we can see here that economically this is interesting because these loan liquidations generate some negative effects for investors who just probably want to hold the token or want to buy the token for other reasons. They are affected by these loan liquidations because much more extreme outcomes are more likely, and since nobody likes risk, that's an adverse outcome for these investors. So in the paper, we look at a bunch of regression analysis on these topics and document the stylized facts in a much more detailed way. But since I only have 10 minutes, let me show you one last picture. So this was, again, one of these liquidation waves. You see in gray here the amount of tokens that were liquidated. We see in orange here the price of the token. And we see here in blue the position of those liquidators. What were they trading? And this graph is interesting because it starts a little bit before the liquidation wave. So we start here about 400 blocks before the first liquidation started. The first liquidation started here at time 0. And what we see is that these liquidators sell the tokens before sell about $500,000 worth of tokens even before the first liquidation started. And then kind of this wave unfolded. And as the wave unfolded, these liquidators were actually buying back tokens. So this is at least consistent with this idea that these liquidators are a little bit predatory, that they push the price down to trigger this liquidation wave. And then as the price of the collateral token collapses, they start buying to make some extra money out of this whole thing. So since my time is up, just to conclude, we want to show that these liquidations can cause some fragility in these decentralized markets. The return distribution of assets is impacted by this, which impacts ordinary investors. There's some of these negative feedback loops present. And why is this interesting? With CBDCs, this system will probably become more prominent in traditional financial markets. And since there is no regulator here in these kind of systems, we can see that this is a challenge that should be addressed at some point in time. Thank you so much. My time is up.